here because we haven't really had you on, in 2022. And, what type of stocks you've been leaning towards over at Seven Investing? Oh,
So
actually, I see previously. Now you're at the Street, who we
yeah,
do spaces with too.
I made a little bit of a change. I am the managing editor over at The Street. Still love all my friends at Seven Investing. Saw Matt a couple weeks ago, but talked to Max yesterday. So still love those guys. But yeah, it's been a little bit different because I'm not, making a once a month stock pick the way I was at Seven Investing. For me, it's more looking at the sort of, call it, false narratives of the market. I think we hear a lot about like, the reason Peloton crashed is because the gyms are open. Well, maybe it's because all the rich jerks who buy Pelotons have bought them. And we need to wait until there are more. And I have friends that own Peloton, so that's a joke. But like, maybe there's just not that much demand because there's only so much demand. We saw the same story with Netflix, where every quarter where Netflix has like a slowdown in growth, no one acknowledges that maybe if like they added 30 million people the previous quarter, that like maybe it's okay if they only add six the next because that's still 36 million over two. And I think you're seeing a lot of that. I think now you're seeing a lot of weird market reaction to the Russia Ukraine potential war. And I'm pretty sure that doesn't affect your Costco stock or your Disney stock or even your Zoom stock. Maybe, in fact, it makes Zoom better because you can't visit the Ukraine. So, that to me, as sort of someone making a broader decision for a newsroom, is really the interesting piece where there's just all these like widely accepted stories out there that I don't think are entirely true. I also think there's a really interesting thing going on with this like massive rush into declaring how electric your electric vehicles are. It came out today that Ford might spin off its electric vehicle division, which is basically saying Ford will spin off its future and leave its old business to die, which may make sense or may not make sense. Because when you have like companies that make four cars worth $80 billion, you can understand why Ford would want to do that. So I don't know. It's been a very interesting handful of weeks, and I'm not sure we're going to get a war, and I'm not sure it matters if we do.
Wow. Can you dive a little bit further into that as to why it wouldn't matter if we did?
Yeah, I mean, it's going to impact stock prices. You're going to see stocks go down. And then I think there are some storylines here. Oil will be impacted because there's oil that goes from Russia to the Ukraine to Europe, which will have a domino effect. So gas prices could go up. But it goes back to this whole, look at most of the companies you own. How much Russia Ukraine exposure do they have? Like the answer is not that much, if any. And will there be some ripple effects? There will. But, we've talked a lot about inflation. Take housing prices and car prices out of inflation, and we don't have a lot of inflation. And everyone, like Walmart came out and said, "Oh, people are really careful. They're thinking more." No, they're not, because if they were, they'd go to the grocery store and see that something was more expensive and make substitutions. And the reality is, they're not doing that. People feel largely good about the economy, though, for whatever weird political reasons, they don't want to say they do. But in general, most of us own stocks that are largely American companies. And even when they're global companies, like, say, an Apple, what's Apple's exposure in the Ukraine? Like, it just isn't that important. So, will this look like, it's not going to be World War II. It's going to look like any of the, like, variety of American wars we've had. So it'll look like Iraq or something like that. It's very regionalized. And we love to sort of overreact as a market to these geopolitical things or like vague political concerns, like maybe Biden's going to do this and the market drops like 800 points. That doesn't actually change the day-to-day business for Walmart, for any of these companies we talk about. Is there some like Ukrainian stock that makes some component of the iPhone? Like, probably, but Apple can figure out its supply chain. And look, we've seen some disruptions. I think last quarter Apple said it lost $6 billion because of supply chain. Did it really? Did it lose it? Or did people just delay their order and push it into another quarter? Are there a lot of diehard Mac fans who went out and got a Chromebook because they couldn't get a Mac with an M1 chip fast enough? I think a lot of times, as a news organization, and I run a news organization, you have to fill your paper, you have to fill your website, your magazine, your whatever it is, whether it's real or not, and latching on to the idea that the Ukraine matters. And my team asked me, like, do we have a strike team if it happens at 2 in the morning? Or And I'm like, no, because first of all, I'm not sure anyone cares what the street thinks about what happens in the war. That our angles will be much more the nuanced, how does this really matter, that you can cover the next day. But I also don't think it's the deal that everyone thinks it is. And we're it's a terrible deal if you live in the Ukraine. There's obviously other potential geopolitical things that could happen, but the reality is, like, I don't know, I own Starbucks shares, and I'm pretty sure there might be Starbucks in the Ukraine, but I can't imagine it's an important business segment for them. And if there is a Starbucks in the Ukraine, it's almost certainly franchised anyway, so it's not particularly relevant. I don't see a lot of exposure in my personal portfolio, but that's not going to stop all of the other websites from covering this as if it's some giant story. And again, it's a lot of, like, as you read the news, and it's what we're trying to do at the street. As you read the news, like, try to figure out, like, what's actually happening. Like, I think high car prices are probably a much bigger story than people are actually covering, but it only gets covered as a chip shortage. Like, it doesn't matter why it's happening. It matters that at some point we all need a car, and travel is being impacted greatly by rental car prices. And everyone's super bullish on Airbnb, but try booking a vacation where you need to get a rental car. Like, the price of your hotel room is not that relevant. That's going to be a lag on Disney, though it hasn't seemed to be, given the complete sellouts over this weekend. So again, I don't want to minimize for the poor people of the Ukraine or Russia who might be in a war, but I'm just pretty sure it's not going to affect the stock market the way people think it is, other than in the short term. And then 2 days later, we'll be marveling at the quick recovery.
Very interesting. So I saw the report 1 hour ago that prospects of avoiding war do seem dim. So we'll see how that factors in. But interesting to hear that you're looking at other areas and see how they're affecting this market a lot more. Did you place any trades this week?
So did I buy anything this week? I bought a little bit more Planet 13, which is a stock I buy pretty much all the time because I cannot understand why it's not doing better. Um, I look at their business, and they own a completely differentiated cannabis retail experience that is set to own Florida, will be the dominant brand in California as it is in Nevada, and will also do a pretty good job wholesaling their products. Nobody else in cannabis is differentiated. MedMen was for a while, and then they spent all their money too fast, and who knows if they'll even continue to exist. So I buy some there. I'm pretty tempted to buy some Disney. If my week hadn't been so busy, I would probably do that, because I fundamentally don't understand why Disney is down when basically they've shown you we can charge whatever we want at the theme parks. Like, there doesn't they raise prices on food. They took fast passes, which were free, and made them cost money. They've inched up the price of everything over the years, and they're sold out for President's Day weekend. Like, I am pretty sure Disney could say, for $149, we also get to kick you in the shin when you come in, and most families would be like, well, I guess my kid has to meet Goofy. I'll get kicked in the shin. And then when you look at streaming, they're almost a victim of their own success. Like, if they've grown slowly, it probably would have been better for the stock. But the reality is, Disney's going to have more subscribers than Netflix 2 years from now, maybe three, and they're going to spend a whole lot less money. Like, name three Netflix movies that you're like, oh, that movie was great. Whereas, like, everything Disney puts out, like, I'm super excited to, like, watch the new season of The Mandalorian. I'm sad that Book of Boba Fett ended. And it's not that that doesn't happen elsewhere. I'm watching Peacemaker. I'll give HBO some credit there. I really like Foundation, on Apple. There's good shows elsewhere, but everything Disney does is a hit, and the stock has been struggling. So that is probably on my list for next week. But with a new job and working 12 billion hours a day, I have not been a particularly active investor or trader.
Awesome. Well, Daniel, I appreciate you coming on, and congratulations on the new position. Excited to see what's happening there, and going to circle around some other speakers, and then we'll come back towards the end and hit everybody for closing remarks and opportunities for next week. All right. Thank you, Daniel. And if anyone hasn't checked out Daniel, we're obviously huge fans of what you were doing at Seven Investing, and we do stuff with the street every single week. So hopefully we can get you on some of these street calls.
Yeah, Catherine actually works for me. So
There we go.
I had her in a meeting today. She's lovely, and yes, I do hope to get on some of those. And I'll just say it quietly, but you guys mentioned the New York Stock Exchange before. I think we'll have a presence there soon enough. So
Okay, let us know. We'll do a collab. All right, awesome, Daniel. Jim, coming over to you. Same type of story. Thoughts on your week slash how this year in the market's been going for you so far, and how you feel with all this news driven sentiment and everything that's going on.
Yeah, sure. I guess I'm a value investor at heart, and I feel like recently, my value instincts have come back very, very strongly. Why is that? Um, Markets have been, obviously volatile, and all I see threads about is, market bottoms, and are we in a bear market? Look, here's a secret of being 30 years of the business. Markets, as well as stocks, can just stay cheap without any catalysts or any viable catalysts to move them. And they're just being moved around on heavy news flow. And, I agree to a certain extent with what Dan says. Everyone's going to have an opinion on the market. And, if you're sitting there believing that, your stocks are going to go up because the market's going to go up, you're off to a loser already. And, everybody is right. It's just a matter of timing. And, and that's the good news. But in the meantime, uncertainty is a real killer. But if you want my opinion, historically, if you look at every single war, markets go up on wars. It's the run up to the wars that essentially kind of annoys the market. So let's cut to the chase here. I mean, value is back in play, and and if you're an investor, you should really be looking at value stocks because value investing, why it has a bad name, certainly with the growth run up of the last, few years, what it spots are companies trading less than their intrinsic value. So what does that mean? What does that mean for risk, really? There's natural downside protection. And, you get all these kind of quotes coming back in my small brain, like, Graham, when he said that, in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And that can't be more relevant than it is now. But, essentially what that means is the speed at which a business success is recognized, um, uh, uh, that's what it means. But furthermore, it's not as important as long as the company's intrinsic value is increasing at a satisfactory rate. So, you're going to wait time for some of these companies to exude the value, really, and that can be a waiting game. And sadly, over the last couple of years, or maybe even years, certainly, people are not used to waiting, and that's a problem because it plays with emotions and it plays with your P&L, and it drives you to make the wrong decisions. So, look, I'm a value guy, like I say. And something I always go on about in these sort of markets, and any sort of markets really, is to manage risk, not P&L. And I'm not that guy who has fantastic stories about upside. One of my great bets over the last 2 months is Organon. And what is that stock? It's a 10 billion company spun off of Merck. It's up 20% when the market's down 10, 15%. Why? It's a great company. It pays a dividend. It's undercovered, and it's just a boring stock. So but it's cheap on valuation, so it's not really moving. But or it's not moving down, should I say? So that's the sort of stocks people should be looking at, really. Stuff that is intrinsically worth more than what the market is. Because if you're trying to play the market, long term, you're just going to be wrong. Because no one has ever been, in my time, consistently right at the time of the market. So other than that, what am I essentially saying? I tweeted today, I'm not a huge fan of Buffett quote, but like I say, these things are coming back to me. It says, the best ideas they've never been better than other people's best ideas. We just control losses. Now, if you can control losses in this sort of market, whether you're a short-term or long-term investor, you're winners on the upside. Everybody is right in terms of picking stocks. Everybody on this chat now will have winning stocks and will be right. It's just how you manage the downside in between. So, and as Dan said, case in point, if you look at some of the stocks today, even on a risk basis, which you should start with risk in any stock you buy, not P&L. You should be looking at in probably kind of three ways, really. And are you buying at the higher popularity? A lot of people bought at the higher popularity some of these stocks. Is everything priced in? Are fundamentals good? For Disney, for example, Disney fits this perfectly. This is why Disney isn't going up. Fundamentals are so good that investor optimism has been downgraded. That has brought the stock down. It's the same in something like Playboy as well, right? There's no question the fundamentals are good. But if investor optimism has completely died down in the stock will stay cheap. And believing, there's no risk in your investment right now, and any sort of investment you have is kind of silly as well. So if you're looking for stocks, you're looking on a value basis right now, you should be looking at stocks which have a catalyst to move them from price to value. Otherwise, they could stay cheap for a long, long time. And I believe Disney is one of those stocks, because what is the catalyst for moving up? You know it's cheap, I know it's cheap, Dan knows it's cheap, the world knows it's cheap. What's going to move it up? So there's not some magical formula that everyone's going to start buying or something. Everyone's got Disney, right? I haven't, but everyone has. So you know what I mean. You've got to take those risk adjusted kind of equations into it. And like I say, it's value investing, but it's value investing with a catalyst. So find out what is going to move that to value, because like I said, most people can pick a stock. There's some great stocks out there, but what is going to move it? So I guess, I concentrate on good quality companies, and I look to, scale into companies. And in this sort of market with the volatility, you can scale in, and but you just got to be extra careful, not going too big too soon. Most money has been lost by piling into stocks, and then the stock just falling for no reason. Could be anything. So, what I encourage people to do is, start with evaluation of the risk of your position, because that's where value investing comes in for me. If anything, you're looking at what is your downside against your upside risk. Okay, we can pick upsides again and again. I keep saying it. Everyone can pick a stock. What do you ever start with the risk of your stock when you go to buy it? I suspect most people don't, but you should. And continue to evaluate your capital on a weekly basis. If your capital isn't in your best stocks or your best positions in terms of value versus price, then why? And lastly, which someone never says, and I never hear it, is it's okay to take a loss. I have taken losses, but don't let them define you. Keep it in the context of you just take a loss and you move on, and remind yourself that other people have taken losses and worse hits than you. So they're the kind of things I want to tell people today, because I've seen these markets a long, long time, and patterns are very, very similar. But we're seeing a lot of noise at the moment, and that's good, really. That's good, because it provides opportunity for your positions if you know them, and that's what you really got to know your stocks inside out.
Yeah, great point there. It definitely is okay to take some of those small losses. We've been talking with people about using the stop losses and then letting the winners run. But in a market like this where there's so much volatility, when something breaks through, and that's why it's so key to have a good understanding, if you're trading, right, versus only for investing, of where your support and resistance levels are, so that you can get in and out. And then also, what I see a lot of people doing, especially if they're option trading or even with commons, is when it gets 5-10% up, or in commons a smaller percentage, going ahead and securing some of that profit immediately off the bat to be able to hold through volatility without taking taking too big of a loss.
Well, exactly. I mean, it depends. You've got to control what your time frame is. I run a number of books, really, which are longer term, which are shorter term, and some of the stops on short term will be additions on the longer term book. So you've got to figure out what your time frame is, and if you're taking profits on, if you're short term trading, you're taking profits on 10% and running your losses 20%. Long term, you are a loser. It's as simple as that, and you have to face that. You're not impressing Twitter, you're not impressing your friends, and the worst person you're impressing is your bank account. So, just be cognizant of, what you're taking and what your time frame is, because there's some stocks that I'm down on and I'm fine with them. I'm totally cool with them. Long term, I'm a winner. I absolutely know that, because nothing has changed. It's the market. So, but there's other stuff short term. I'm thinking, well, you know what? I want to get out on a short term book, because I just don't like it at all, and sentiment isn't there. So, you got to figure out what your time frame is compared to your risk, but start with the risk. I never see that in any threads, in any Twitter spaces. Everyone's like fantastic stories of how much upside this stock's got. How much downside has it got? That's what I ask. That's the one question I always ask first of all to my analysts. What is the downside of the stock? And that's what we investigate. How much can I lose? And that's what you should be asking in everything you buy at the moment. You should be nimble and you should be smaller than normal in a volatile market.
Love it. Jim, I know that you have to run in a few minutes. Any other opportunities on your radar for next week? Any specific names or sectors?
Yeah, I mean, I wrote a couple of articles. Really, I sort of write on Forbes for the side just because they asked me to. I mean, I don't really get benefits out of it actually, but it's just I'm passionate about people winning as well. I wrote a couple of articles recently on Airbnb. I was in that stock. That's rallied up nicely. I think Airbnb is a classic of revisiting some of these great growth stocks. Uber is another one I'm a fan of here right now. And if you type Jim Osman Forbes, you'll see two of those. My write up on Uber, my write up on Airbnb, and they're not everyone's cup of tea. But at heart, I'm a contrarian investor, and I'm going to get a lot of shit for stuff that I like where people don't like, and that's fine, and I'm cool with that. But Airbnb is a stock which I like, which can return you. Like I say, do your own research and none of investment advice and all that sort of crap. But I think it can return a good 50% to you in the coming years as a stock where people are the pandemic has brought a lot of this forward in terms of people moving around, people holidaying, and it's a great company, and it owns nothing. Remember, it doesn't own anything. So, and you've got this visionary CEO as well, which people say to me, "Well, Jim, who are the visionary CEOs today?" Well, take a look at Chesky. Take a look at the CEO of Airbnb. He's got a good vision on stuff. He started the company. He's a homeless guy, and now he's a billionaire. And that happened in a pretty short space of time. And the thing about visionaries is you never want to sell them because they're always going to spring something on you in the back door and essentially reinvent their business or reinvent themselves. Tesla being a case in point as well. So that's one to look at. I would say Airbnb. Have a look at my write up on Forbes. You can check in with us for some more analysis, the deeper analysis. But yeah, I like that stock, and like I say, there are a couple of stocks there, and Uber. If you want to buy into, not so much, some of that growth stuff, which is like way out there and way overvalued, but some of the good growth stuff with a little bit of value tucked in as well.
Awesome, Jim. Appreciate you being on here.
Absolutely. Thank you very much.
Thank you. Okay. 100%. If anyone hasn't checked out Jim, you can look in his bio. He runs the Edge Sea Group, and you can check that out on there. There's a lot of good information on everything he's doing, a lot of good writing as well, and just different articles. So appreciate you joining us, and we are going to keep it rolling on over to James. Great having you back on the Weekly Howl. Excited to hear how your week has been in the market and just what areas have been attractive to you.
Hey, Gavin. Thanks for having me on. Could you hear me?
It's a little faint, but I mean, we can hear you. It's just a little faint.
All right. Could you hear me better like this?
Much better.
All right. Yeah, it was really awesome listening to your former speakers. I really like what Jim had to say about risk management and how it's pretty much one of the most important components of trading. With risk management, if you protect your capital, the profit will come naturally on its own. As long as you mitigate your downside risk, you really have unlimited upside potential if you're doing it correctly. Obviously there's a lot of things going on right now. We have fear in the market because of the Ukraine and Russia situation. And, the stock market is forward thinking. So when there's fear and uncertainty, it leads to volatility. At the end of the day, I don't pay so much attention to the macro events. I think price is the most important thing. and price is what pays. For all of you that aren't familiar with me, I'm a swing position trader. I'm not an investor. Um, a lot of my trade is rooting in the IBD and CAN-SLIM methodology. Basically, what that does is it takes the fundamental aspect of trading combined with the technical aspect of trading. So you're basically looking for the strongest stocks from the strongest industries, and then you're looking for those stocks to come at a sound basis on volume. So for the most part, this week, I really haven't been trading that much. I did take one position in Zim. Shipping, oil and gas have obviously been the leading industries in the last couple of weeks, the last couple of months. So I really like to, focus on like the leading industries at the time. But I'm pretty flat with my trade on Zim. This isn't really my ideal trading environment. I like to really put the foot on the gas when the deck is hot. William O'Neill did a really interesting study, and he found out that about 75% of stocks move with the general market. So he basically said, why would you want to trade in a market where you only have a 25% chance of winning? And at the end of the day, trading boils down to probability and odds, and having those odds in your favor. And when I don't feel the odds are in my favor, and when I don't have an edge at the time, I have no problem, sitting in cash. I'll day trade a little bit here and there. I'll size up a little bit larger than I usually do. I'll double, triple my position and look for really tight risk spots that I could get in against. Take really quick profit the same day, maybe a little bit of shares overnight. But for the most part, I've just been sitting on the sideline. The NASDAQ isn't too far away from taking out the day one rally attempt lows. If you're not familiar with what a day one rally attempt is, during a correction, you basically look for the first up day, and then for a follow-through day afterwards. And we did get a follow-through day, but if that day one rally attempt low is taken out, then that rally attempt is basically dead, and we're not too far away from taking out those lows. And then on top of it, I've been posting this chart quite often. The NASDAQ and S&P both have head and shoulder patterns forming, which is a topping pattern. They're both basically within the right shoulder of that pattern. So I think that's definitely, if you're a technical trader, it's something that you should definitely be keeping a close eye on. And things, I just kind of want to touch on something too. Over the last year, many growth stocks have basically been in a bear market. You got stocks like Twitter, RK, SoFi, Roblox, Twilio, SCW, Shop. These stocks are 60% down from their all-time highs. DKNG, Roku, Pins, PLTR, TDOC, Affirm, Zoom. These stocks are 80% down from their all-time highs. So even though we're not technically in a bear market yet, we're just in a correction. Many stocks have already basically been in a bear market over the last year. So, I just suggest to people, be careful out there. What you think won't go any lower can get a lot lower. I'm sure, many of these stocks are FinTwit favorites. I'm pretty sure that many people thought that the lows in were many different times, and now they're down 30, 40, 50% on a position. So even if you're an investor, use stop losses. You could always try to get back into the stock at a different time. There's no reason to take heavy losses. The more you eat into your capital and the more you eat into your account, the harder it is to get that money back to where you were originally, and you wind up making bad decisions, trying to make up for the money you lost, and you just wind up digging yourself into a deeper hole. So, if you don't feel that you have an edge in the market, there's no reason that you have to trade. Uh, Wait until we see a clear change in trend, and then you could start to put your foot on the pedal and see if positions start to work. If positions are working for you, if you're able to lock in profit, you can start putting on some more positions and start progressively increasing your exposure. So, I just really hate to see people lose money. I see people make mistakes that I made in the beginning, and there's no reason for it. But unfortunately, in the stock market, you know, you got to burn yourself on the stove, and you got to learn the hard way. Somebody could tell you something a million times until you're blue in the face, but until you actually experience it yourself, nothing's going to be done about it. So that's pretty much all I got for you today, Gavin.
Good stuff, man. Always good when you hop on, James, to hear from you. I'm going to come back around to go into more of the specific areas of opportunities for next week. My one other question here, and then I'm going to go over to Wolfie, is with so much news-driven cycles, have you been playing the downside at all?
No, I don't really short too often. A lot of people I know out there like to play the short side. If I see an opportunity, if I see something that just stands out to me, and I'm like, all right, that looks like a really good short opportunity, I'll play it, but it's not something that I'm looking for, and it's not something that I focus on.
Cool, man. Yeah, that's definitely fair. I've seen people taking all different types of approaches to it. I appreciate you coming on and giving a little bit more insight, and we'll come back around closer to the end to talk about some opportunities for next week and maybe any specific names that you're liking setups on.
Yeah, man, absolutely. Yeah, I just like to stick to my little niche, what I'm good at, and I like to master my craft.
Perfect. Awesome, James. Thank you. All right, Wolfie, appreciate you hopping up on this. Excited to hear from you about your week in the market and some alpha.
Yeah. Well, we had a gold position put on last week, so I've just been riding that. Dumped most of it yesterday, and we've just been really defensive. For the most part, we've been defensive for the better part of 2 weeks, 3 weeks now. Shorting strength. There's no leadership in the market. There's no real place for leadership. And what was leadership is starting to kind of fizzle out, and that was oil. Oil was outperforming for the better part of the year. It's starting to show a little bit of signs of just either flattening out or going sideways or whatever after the run that it's had. But there are some interesting things in the market that have gone under the radar. So for me, for the most part, I use technicals, but it's not just looking at moving averages and looking at where to buy. I'm looking at general market sentiment and where we are in general. So last week when we were making, I think it was last week or the week before, I don't remember. We were making new highs during the week. So it's not making all-time highs, but we were making new highs during the week. And when we were pressing up to make new highs, something like 80% of stocks were making relative or absolute lows. So that was a tell telling you that it's very top heavy, and a lot of stocks still were struggling. Outside of that, what I like to use the rate of change on moving averages, and I like to use the rate of change on the VIX. I think the VIX in general is a good gauge for where we could be, on a bell curve, but I don't really look at it in terms of whether it's valid or not. So you take a look at the VIX today, it's down nearly 1% right now as I talk, and that's not really indicative of what the action was like today. It was a pretty volatile session so far. But if you look at things percent of stocks above their 10-day or above their 50-day, which is a good sentiment for me. It's a good sentiment gauge. Typically, I look for the percent of stocks above their 10-day to go below 20% before it tells me on a short-term basis we're starting to wash out. And then below 40% for the 50-day. And so currently we're like at 25 and a quarter and 36 respectively. So one of them's kind of flat, like on the intermediate term. We're getting to a point where it's getting close to potentially seeing a snapback. But on the short term, it's not there yet. And then you take a look at just like individual stocks. So take a look at like Apple, Microsoft, Amazon, Google, whatever. I heard previous speakers talking about like people assign headlines or they assign news or whatever. But that works both ways, right? So on the way up, everyone was looking for any excuse to own these stocks. And now it's kind of like there's no real leadership. There's no real reason for these things to elevate the way that they were elevating. And so people are looking for material reasons to come out and say, oh, this is why this is happening. But by and large, like these are just these dislocations are just like mechanisms for trying to find an accurate read, an accurate price. And a lot of times they overshoot to the upside, overshoot to the downside. And then on top of that, you have people that have short-term time frames, intermediate-term time frames, long-term time frames, right? And so when you dislocate to the downside, all those different types of investors have to reassess, and then it doesn't matter if you're a 5-year investor. If you bought Peloton, let's just pick on Peloton. Say you bought Peloton at $100 and it goes down to 30. You really have to reevaluate whether or not you think this is still a 5-year plan, unless you're Cathie Wood. And so by and large, you get that added selling pressure, et cetera. Outside of that, I think there's a lot of things in this market right now. I posted earlier on Twitter that it reminds me of August of 2015. And I know a lot of people who are active on FinTwit probably weren't around August 2015, but we had some selling pressure in late August, and then it was exacerbated after a weekend on a Monday where we like gapped down on a headline. It was like a panic gap down, but that panic gap down was like actually the panic low, and then people bought it. So I'm seeing a lot of stuff like that kind of reminds me of it. And there's a couple of tells just from like a depth perspective. So this week, for example, we saw PPI, which was way higher than where it was expected on a month-to-month basis. It was up like 1%. That was telling us that inflation in the short intermediate term is going to be worse because this is an intermediate measure. And if you just took that headline in a vacuum, you're like, oh, this is bearish, right? But if you looked at the bond market, looked at 2s, 5s, 10s, whatever, they were flat and unchanged. So they were basically saying, yeah, inflation is going to be bad in the short run, whatever. And then it suggested that like the fear of inflation in the Fed, which is what was driving the market before, no longer was the catalyst for what was driving it moving forward, right? And so if you just take another data point, if you look at the beginning of the week, before we had the minutes announced, the expectation for a 50 basis point hike in March was sitting at 90%. And that's from the futures and OIS, right? And so if you take a look at it now, after we've gotten that and after we've gone through this mud-riddled week that we've had, that 50% or that 50 basis point hike is sitting at 30%. So we've like done nothing from like materially from a headline perspective, and people's expectations have ratcheted down for like how aggressive the Fed could be. So, with all of that, we get to a point where, at some point, Russia either invades or they don't invade. And either they invade and it becomes an isolated local issue, and then the market starts to try to price it in, or it becomes an exacerbated issue that's like significantly worse than we expected because we're on the verge of World War III or something like that, right? And so generally speaking, if the latter is not where we're at, we could see an instance where it doesn't really matter what they do on a short-term basis because of just like how aggressively some things have sold off and how aggressively we have snapped and we have dislocated. And then it's just like a rip the Band-Aid off moment where it's like, okay, this has happened. Now how do we deal with it kind of thing, right? And so with all that said, now we could start to assume that the probability for like an aggressive Fed move in March is probably coming off the table, and it could be a little bit more tempered. And people who have been aggressively on the other side of that trade have to reevaluate and reposition. So that's kind of like how I'm looking at it, what I'm looking at. You know, with all that said, we're still like with growth and a lot of the names that we're working in the last several years, a lot of those names are still in a bear market. So you're going to see these violent reversals to the upside, get back to pivot points and overhead supply, and then roll over. But the largest, in general, the largest rallies that you see happen in those types of markets. So could get to a point where a lot of this bad news kind of gets baked in for short term, get a snap back, and then reevaluate from there.
I mean, I would hope so. It's a little terrifying with, we've had this drop, but it hasn't really been super reflected in the indices. So I think for a lot of retail, especially people on FinTwit that are holding those names, right, I think that they could be subject to further fall, especially because portions of their portfolio that were weighted up were by the large caps, which may still have, downside, especially if, SPY can't reclaim some key levels today. I think, you go through the long weekend, you come out into the next week, potentially there's a war declared. It's a very tumultuous time period.
Yeah, but the whole I agree. The whole point I'm making though is if you're not like if you haven't been scared off the ledge, let's just use Apple, right? If you haven't been scared off the ledge on Apple today, it could very well open at 162, right? Like let's just say it could very well open at 162. But the person that saw Apple go to 183 and go to 160, go to 167, 165, whatever it's trading at, if it were to get to 162, most of those people aren't going to be swayed by that $3 move. You'd have to see some like real material selling in names like that for those people to be swayed. So that's why I think that you could see bounces, but those bounces aren't to suggest that you're going to see a bounce and continued rally to create a new high per se. But you could see these bounces and see a little bit more of this chop. And then the premise here, if you're optimistic, is that you hope that a lot of these names that get wiped out or that have been getting wiped out get to a point where they flatten out and they start to reverse course as some of these bigger names start to sell, which haven't sold, right? So if you could get, a majority of just like pick on the Cathie Wood stocks, the majority of those to find some sort of floor, it could offset some of the damage that could come from some of these mega caps. But I say all this with the caveat of I'm really risk off. I've been, I have a tweet pinned at the top of my page, says that this year's the year of the shit trade. And that's essentially like legacy semiconductors, necessary healthcare, industrial oils and things of that nature, and then travel. And a big part of this is we've gone from a goods economy and we're going to transition to a services economy, right? So for the last 2 years we've been locked in. A lot of people haven't done some of the normal stuff that they have been doing in the past, and so they bought a lot of shit to offset that. And now I think in the back half it's flipped. So I don't need to buy all of these things. I want to buy experiences. I want to go places. I want to do things, right? And so you're still going to have that rebalancing aspect. So you're going to have a lot of these bigger names have to sell off and come down some, and have some of these smaller names create new leadership, and they still don't have a material impact on the market overall.
Well explained. Appreciate you weighing in on that. Awesome stuff, and great having you on. And going to go to Matt, and then we'll come back around to everybody. Matt and stock market news, and then we'll come back around to everybody for some other comments. But appreciate you being up here, Wolfie. All right.
Thank you.
Yep. All right, Matt. Floor is yours. How was the week in the market?
Everything's going great. I've been doing a lot of scalping. If you guys follow on my Twitter, I do this this challenge, right? I just show how like a trader, it's all to celebrate the risk management platform we're doing. So like I'm doing a small account challenge, right? Just taking a small futures account to an equities bankroll and going to trade stocks and options with it. So this is day 15 and it's been a 15-day streak. So I've been pretty good. Lucky for me, but it's because I'm really kind of being risk off a lot. I'm taking small trades, getting in, getting out. All the signs to me are southward, and still southward. I was kind of hoping after NVIDIA earnings and after we got through that really nasty catalyst day, we had FOMC minutes, potential breakout of war, and all this stuff was piling up. I was kind of hoping to see the market base out and so show some good signs of short covering going into monthly options expiration, which is today. But seeing the way the VIX has responded to this really shows me that we're building up for a flush. And I hate thinking of those things because those are the days that really the market just kind of for one day confirms to everyone that it's bearish and the next day it flips around. So essentially, I mean, I'm looking at all kinds of signs. I'm looking at high yield debt. I'm looking at the VIX and VIX futures. I'm looking at the commitment of traders. All the signs right now do point to the idea that the market's liquid, but it doesn't look like it's going to base out from here and turn around and rally back up to double top. I really do think we flush really quick for a day or two, short week next week, and then when everyone's convinced it's now crashing out, it turns around and covers. I don't think we turn into a bear market from here. I like what Daniel was saying earlier. Kind of reminds me of a story I used to tell. I don't know if I've told you guys my COVID toes story. But when you think about the news, right, do you think the Russia-Ukraine conflict has anything to do with the U.S. stock market? Absolutely not. Zero to do with all the stocks for all the reasons Daniel said. It just has to do with right now we're kind of running out of bad catalysts. And the COVID toes story is kind of like a narrative into the ethics of news reporting, right? It's somebody's job to write a news article every day. And when there's not a news article, they got to explain something. And they're not the most they may be great traders, maybe not, but they're not, as in tune to the market as a professional trader would be. So they just gonna have to kind of say, this is maybe why things are happening, even if it's not. And so a lot of the Russia-Ukraine may be causing any downside to the market. I would say that instead, it's probably not causing people to just be exuberant about, shifting their money around right now. We're kind of in this wait and hold period. So the COVID toes story, it goes like this. And let me open up my SPY chart. So, when COVID first came around, everybody was hearing about it, I guess, late November, December. We had the first cases and then COVID came out and market completely crashed. And then maybe about a month or two later, there was some news effects coming out that saying, you might get COVID a second time. We don't know. Maybe you can get COVID again. Maybe you can repeatedly get it. And then after that, they said, wear your mask. It's, we don't have vaccines yet, but all these different things. Then everybody went to quarantine and came out and got to get COVID again. So the news was COVID's going to get you twice. And then after that, it was like, COVID makes your stomach hurt, and COVID makes your eyes fall out, and COVID makes your toes turn green. It was weird stuff that just kept spinning in the middle of that bear sell-off that people were just trying to fit every single tiny little effect that someone could tie to COVID they did, because they had to have something to talk about. And COVID toes was kind of the joke, because it was like, COVID makes your toes fall off, because there was one case someone's toes fell off and maybe they had COVID. Well, the idea was the news kind of progressively becomes a little more, whether you believe COVID toes or not, I'm not going to start a debate on that. I'm sure no one believes it, but it sounds a little ridiculous, right? To a point where the news moves from genuine fear to kind of ridiculousness, and then it tapers and falls off, right? And it usually gets ridiculous into the end of a rally because there's nothing else to talk about. And it's sad that, anytime two countries could possibly go to war is always bad for the countries. The effects it could have could be in something like commodities markets. Oil is going to be obviously very sensitive to news like that. But yeah, your Disney stock and Roblox and those things, none of that cares about what's really kind of going on over there. And it just comes down to, it's the only thing to talk about right now. We've literally priced in 50 basis points. The futures are showing, like Wolfie said, 90% and greater for months. And now we're sitting there thinking, okay, that's priced in. People have been selling. That's priced in. The aggressive policy of the Fed, that's priced in. There's really nothing else to, when markets are panicky, it's almost like, hey, talk about something panicky. It's not be the only person on the street to talk about something hopeful and cheery. Market's going to bottom out. They're not trading experts. They don't really understand the liquidity of the markets and how those things work. So when the news is bad, they just have to keep going with the flow, right? And so we're kind of just running out of bad news at this point. There's really not much else that can turn the market lower. I mean, we had multiple rate hikes in 2018, very tightening fiscal policy. We even had a trade war, and guess what? Market rallied really, really hard. And the idea comes down to, as long as markets are liquid, they don't sell off. That's like the general rule of thumb of any kind of market, whether it's houses or cars or whatever. If there's a buyer for every seller, price typically stays put. And when things stay put, then they just become a tandem to inflation, which means things just go up. And that's kind of why indices always go up, because typically there's always a buyer. As long as you have a job, you put your money into your 401k and you're buying stocks at that point. And as long as there's a buyer for every seller, markets just sit still and then indices go up because of inflation. That's typically how things always happen. And so the question really now is, despite all the news and despite all the bad news, do we think the market's going to stabilize here and turn around and rally? And in all honesty, I was hoping that at the end of the earnings season, we would kind of see just, I guess, the S&P not finding lower lows, which actually happened. Thesis number one, support's okay, not too bearish. But I do think we do double top before we become bearish, if it's possible. But I don't know if it's possible. I'm kind of still on the bull side. But the way we've closed out in VIX monthly options on Wednesday, and then we had options expiration all monthly stocks, or it's all monthlies for stocks today. The close is very alarming. The way the VIX looks today, that it's slowly building higher and higher and higher over the last 3 days, almost kind of spells out what I would call a flush day. And a flush day could be next Tuesday or Wednesday, where the markets just collapse on a volatility event and just fall and fall and fall for like 2 days. And then everybody's convinced the market's selling off. And then it usually turns around and goes right back up to the top. And I really think, just like 2008, that if there is any kind of bear cycling or any kind of correction market, we have to kind of double top before it happens. Even the financial crisis of 2008, 2009, and 10, you had a double top before it sold off. And you had a massive bubble that popped, right? We don't really have a bubble right now, and that's the weird part of the market. The market's been floating on short squeeze. If you look at S&P futures, right, and the committed traders for the last 8 months, the asset managers have been selling their net long in abundance to the people that are covering their shorts. Short squeeze has pushed the market up. So now the shorts are out of their position, and that makes sense for a flush because nobody gets paid out if the shorts are out of their position, and the market dips down and people find the value and get in. I think that we're going to be healthier than most people think. I just don't think it's going to start on Tuesday. I was kind of hoping that today we get a bigger squeeze into close, but it doesn't look like it's actually happening. So I'm in that camp that I really do believe that the market will be stable. The liquidity's there. The Fed wouldn't be letting things expire on the balance sheet if we weren't liquid enough, because they can't risk the stock market collapsing and people losing their jobs again, because the second time markets crash due to whatever circumstances or stocks come down and people get laid off again, then that logistical problem that's taken 2 or 3 years to solve will probably take 10 years to solve if we crash a second time, right? Nobody at all would risk that. There would be zero faith in a recovery at that point. So we know, with all the language and all the different voting bodies of the FOMC, they people are kind of more hawkish than expected, but I don't think it's because they need to taper for the sake of slowing down the economy. They just don't need to be the ones holding all the risk when there's enough buyers here from all the COVID shorts covering. They're passing liquidity on the market, which is the understandable, correct approach, I think. And I think they're being really smart about it. And in reality, they have all the handles in the world in the narrative to say whatever they want to put hope back in the market. They can rate hike every 2 weeks, and then every time they rate hike, they can say, well, we probably won't do it next week, though. And all of a sudden, market's going to completely rally off of just the words alone. So there are handles to preserve the economy, or the stock market, if they need to. The economy is not necessarily unhealthy. One of my tricks, I look on Newegg to see like how many 3080 Ti graphics cards are there, just to see the prices are coming down, because it looks like things are starting to get pushed down to the market, and the natural competition will bring down prices. The month-over-month CPI has been kind of tapering down as well for the last maybe 3 or 4 months. So, I mean, it shows that inflation's not getting much worse. I mean, it's still very prominent, and it's just a slow roll to get things back to normal. I really do think that it's all signs are kind of weird looking. They're not great, but they're not terrible. I mean, a lot of historic rallies have started from points like this. So, I mean, I'm hopeful. Call me one of the hopeful bulls out there, but yeah. But in my own trading, I've mostly been scalping. I think I posted my statement from the challenge on my Twitter. I think my average trade is like what, less than an hour. I mean, I'm in and I'm out. My average winning trade 35 minutes. Yeah, I mean that's how in and out I am. My losing trade, if I have to dig out of an hour and a half, I'm in and I'm out. Like I see the momentum. I take the little play and really get out. It's not really a directional market right now, so there's really no short term plays I can see. Most everything is looking really bad. High yield debt's looking really bad. The HYG, one of the indicators I look at, I mean, nothing looks great yet, but nothing's terrible. So that's kind of my whole take on everything, I guess.
Yeah, yeah. I hear you, Matt. It's definitely been rolling with it. I appreciate the optimism. I hope we roll into next week and get a little bit more direction.